All right, hello everybody. Mike Gandolfo here on More with Mike, and this is a show that helps real estate agents, helps real estate agents actually initiate, facilitate, and drive positive transformation in the real estate business. And today, I think we've got a great topic because we are talking about how we can help buyers actually get on the path to homeownership. I think we hear it all the time right now. A buyer says, "Oh, I can't afford to do this. I can't afford to do this. The price of getting a home is too high." People saying it's unreachable for me to buy a home. And we're going to talk today about why that is not the case and what we can do to help our people prepare to make the jump and get into home ownership. So I've got two guests with me today. I've got Brian Phillips, who has, obviously done a lot of these kind of things with me in the past. So it's great to have Brian back. Brian is a mortgage lender. And the reason why Brian is here is because if Brian hears from someone that, I can't afford it, or if he runs and they don't get approved for what they want to get approved for, Brian doesn't just discard them and say, "Well, call me when you're ready." He actually helps prepare them for what they need to do to get to where they want to go. And one of those things that he does is helps them budget. So our friend Chris Adkins is also joining us today. And Chris is a budget specialist. He just came out with a service, actually, not really a product, called the Budget Blueprint. Is that right? It is the Budget Blueprint, right, Chris?
Yeah, the Budget Blueprint.
There it is. So Chris is going to talk a little bit about the budgeting process he goes through. And our goal today is, if you're a real estate agent, you won't just have a buyer say, "Hey, I can't afford to do this just yet." And then be like, "Okay, well, just call me when you're ready," and let them just drift off into the wind, never to be heard from again. That you will actually have actual tools that you can maybe even some actual dialogues that you can have with them so that you can get them on the path to home ownership. So how you guys doing today? Brian, how was your Easter besides the flies?
I'm glad that we got there when we did, because I think I would have freaked out. Chris, I legit think I would.
Brian's my brother-in-law as well, Chris. And so we get to my parents' house last night for Easter. And right as we're getting ready to have lunch at my parents' house, they had I don't know, a whole bunch of, I don't know if there was some eggs and they all hatched at once or whatever, but they were all coming out of this one windowsill. Hundreds and hundreds of these fish flies. It was bizarre. So anyway, here we are. We're talking about home ownership. I'm going to share some data, and then we'll kind of get into some of the stuff. There's a really cool MBS Highway does this report every year, or anytime I want to grab it, actually. So this data is actually good as of today. To just kind of talk about some of the reasons why this conversation is important. So the first graph that you're going to see up here in the top left corner is the forecasted appreciation that's going to happen in Jefferson County, Kentucky. So this is specific data to Jefferson County, Kentucky, where Louisville is. And you can see that they're expecting over the next 5 years to a home be increase in value by $56,000. Now, Brian, I'm not sure, but that probably means if I'm a renter, that my rent is also going to be going up in that time frame too, right?
Yeah. If somebody's going to sign a lease agreement, you want to take a look or at least ask a professional, a friend, somebody that's rented before that knows a little bit about law. Ask them to read the agreement to see what the max is that your rent can go up on an annual basis.
And when you look at this, you're going to basically, if you were to buy a house, that means you lock in a payment right here at year 0, and your payment does not go up, but the value of your property does. So it builds equity for you as you're paying off that loan, and you're getting equity in your property. Meanwhile, if you were not, you're paying someone else's mortgage, and actually, because of the demand on rent, they can actually choose to increase the rent as this goes up, and all that's doing is increasing the profitability for the landlord who had that payment locked in a long time ago. Now that historical appreciation shows an average of 3.83% a year. As you can see, over the last 5 years in Jefferson County, we've seen 6.5%. Over the last 10 years, 5.17%. But over the last 63 years, it's been more than 3.27%. So this is a very conservative estimation. Don't you agree, Brian?
100%. Yeah. And it's interesting because that forecasted appreciation, to those that own a house, that's exciting to see. To those that want to get into the market, it's probably incredibly intimidating to look at.
Yeah, it's interesting because one of the things, and I guess this is a good place to start, is one of the things that when we have a client say, "Hey, it's not in the cards for us to buy right now or whatever else. The interest rates are too high, blah, blah, blah. And I'll just say, do you feel like it's going to be cheaper for you to buy a house in the future?
Yep.
And they have to think about it for a little bit. And some people will say yes, and some people will say no. And the people who say yes, I'm waiting for the market to crash, which we don't hear that as much anymore. I would just say this. The market crashing would be because we have way too much inventory of homes and not enough buyers. And we are so far away from that. It's not even funny. Like that is not a thing that we're going to see happen in the foreseeable future. And then the other thing I tell people is the house that we live in right now, we bought before the 2008 recession. And when we bought this house, I was a brand new real estate agent. I had no sales history whatsoever, and I was full-time. I had no other source of income. My wife was a Catholic school teacher, which means she made way less than a public school teacher. And we qualified to buy this house without selling our previous house. So that doesn't happen anymore, Brian. They don't make those kind of loans.
No, yeah, the days of if you can fog a mirror, you qualify.
Yeah,
those days are long gone. And it's a shame because a lot of people still feel that because in their mind that they can afford it, that they should qualify for it. And it's just not the case.
So then the second question I'll ask them if it's going to get cheaper. And then I'll just say, well, is your financial position, and this is where Chris, I think, kind of really comes into play, is your financial position expected to dramatically change in the next 12 months or in the next 24 months, in the next 3 years? Like, what is going to change in that next year to 5 years to make it more affordable for you to buy a house versus right now? And Chris, a lot of times, and this goes down, I think, down to this affordability index number that we see down here, which is at 130. And to give people some clarification, this is again Jefferson County, Kentucky, not the United States, not even the entire state of Kentucky. This is Jefferson County only. This means that if it's at 100, then the median income can buy the median house price with a 20% down mortgage. Okay. We're at 130, which means we're still on the affordable side. But as you can see at this graph, we were at the high of somewhere in the low 240s. So it's definitely different than what it was. We actually saw it tick back up here a little recently where it actually got a little bit better. So we're actually seeing affordability maybe got down to 125-ish, and now we're back to 130. Chris, it's not necessarily that people can't afford it. It's, are they willing to make some of the sacrifices of the lifestyle they had when affordability was up here? Yeah. Are they willing to kind of put some of that stuff aside because that, I want to put my money where it grows and not where it shows?
Yeah, I think there's two things that stand out to me in what you're saying, and I think there's a large misconception there for first-time home buyers that you said the average right here is 20% down, right? I don't think we're seeing a lot of people in the average go out and buy their first-time house with a 20% down. Now, is it advantageous for them to have the 20% down? Sure, right? But you're going to have to weigh the pros and the cons, because what we're also seeing is that appreciation grow over time. And so, Mike, me and you have talked about it previously, is that we're seeing the average age of first-time home buyers increase, which means that their ability to start collecting or being in that equity position is now later in life, right? And so as somebody who's 26 and is paying on their, goes in, buys their first house responsibly and pays on their mortgage for the next 10 years, could sit at $100,000 equity, while somebody who's 36, buys that house at 36 and now they're starting with zero equity, right? So the equity game is a big piece to consider in this entire process. And it's making the right decisions. Going out, am I going out and, do I have a large budget for clothes or coffee? Those things that maybe I could dial those back and be able to purchase my home, at an earlier age, rather than saying, hey, I really want the Nikes. I really want the Starbucks. I really want all of these luxuries, every day, and that's a lifestyle. So it becomes a lifestyle choice, and you have to make sacrifices. But those sacrifices will pay dividends in the long run. And so I think it's important for people to know that, you know, it, there are opportunities out there, right? There are ways to get into a home earlier without having the full 20 to 30% down and still do it in a responsible manner.
Absolutely. And I think that this is where, like, I look at this pie chart, and actually I'm going to pull just this pie chart. And this pie chart real quick, I know it's a little grainy, it's not great, but just this again is in Jefferson County. In Louisville, Kentucky alone, there's almost 73,000 renters out there who could actually afford to purchase or are choosing to rent. Okay. To give context, and the highest real estate year that we've ever had from a transaction standpoint, and this is the entire MLS, so this includes the surrounding counties, was about 20,000 home sales. So, like, if all these people decided to buy, it would literally probably break the system. But we still have 73,000 people who are on the sidelines, who could afford to buy, who are not taking advantage of that appreciation cycle. So you mentioned the average age of the first-time home buyer is up to 38 years old. 15 years ago, it was 29. And it's so hard to catch up, and when you're playing from behind with that equity game. And so right now, if we have someone who's in their 20s buying their first home, and they're buying something that they might not necessarily want to live in. I'm not going to sit here and say that they're buying something that's all trimmed up and ready to go. They're buying something that they might not necessarily want to live in. They're buying something that they can put a little elbow grease into and get some equity that way. But then they also know that the value of their property is going to go up as well. But their buying power the next time through, Brian, is just that much better.
Yeah, absolutely. And so it showed that the median sales price was about $298 on a $298,000 house. If you put 5% down, that's about 15 grand ish. Another 7,000 for closing. You can more than double that money within the first 5 years just in equity alone. The majority of people don't have the discipline where they could save that money by paying rent and putting that money in the bank or investing it into something else. So yeah, that's the part where it's hard to outpace your equity position when you've got appreciation in real estate.
It really is. And I think that's one of the first things that we recognize with people is that, hey, you're paying someone's mortgage. Like, you know, you're paying your mortgage and you're getting the advantage of the equity, or you're paying the landlord's mortgage, and he's getting or she's getting the advantage of the equity. All right, Brian, you get that person. How often is it happening right now, by the way? They're like, hey, man, just right now is not the time for us to buy.
So a lot of times it's when they already found a house that they like. They're looking at one of the online mortgage calculators, and what they don't realize that the payment they're seeing is with a 20% down payment. Homeowners insurance, that's less than what it's really going to be. In early 2024, we saw insurance policies increase between 12 and 18% in Kentucky. Wow. Yeah, property taxes too. Jefferson County, they're now going through another reassessment. There were 7 or 8 big zip codes that were changed, and now they're going through it again. So yeah, so those people that are waiting, they're going to pay more for the same house. So they almost need to look at a house that's 5 or 10% below where it's at now, if they're going to buy in 2 years.
You mentioned the online, the click button, get mortgage. I want to also warn people that very company right now is also doing something that they're saying that they're going to help you identify what subscriptions you have available and help you get rid of those subscriptions. And you need to understand as a real estate professional, when you're talking to your potential buyers, that this is one of those things that is a trap for them to get your information and to get all of your data and all your financial information so that they can market directly to you and look at your spending habits and understand when you're potentially going to purchase something. It is a way for them to try to compete at a whole nother level. It is not some sort of free service. It is going to be something that, where they're going to be inundated with marketing to them to help them buy a house. And Brian, I know that we weren't really going to talk about this, but just talk about what's the difference between using I'm going to be real honest. I've had good experiences with that company. I've had bad experiences. If everything goes smooth, they're fine. But if there's issues, and by the way, I just did a talk in Baltimore, and part of my speech was about the percentage of transactions that actually go totally according to plan. Only 8% of transactions go according to plan, where it's like, oh, it's no issue. 8%. So for those 8%, if you're one of those 8%, which if you want to gamble on that, go for it. That might be a fine way to go about it. But Brian, why do I want to have a local lender who's in my corner?
Well, they should care about their reputation. They also have relationships within the industry. So I know that whenever an offer is being submitted, I'm already aware of it. And if I know who the agent is, that's great. Because then when I make that outbound phone call, like we're at an equal level where they don't have to worry about me being too busy answering inbound phone calls to take their calls. So
and I think at the same time too, it's like when we can have this conversation together that this person might not feel like they're ready to buy, and we can put them on the path. It's way more powerful when it's, the agent and the lender are lockstep, they're communicating, versus it's just some sort of file number at a call center, right?
Well, yeah, I mean, it's a team approach. We're all looking to accomplish the same end goal. We want raving fans, the listing agent, you as the buyer's agent. We all want those buyers and sellers to be raving about us to their friends, families, and coworkers. That's what grows success.
All right, so let's tee Chris up here, Brian. Talk about when you get that person and you're really good in that initial consultation with them, talking about their budget and helping them understand what life is like and trying to get them to start living in what their new payment will be, right? That's something that you're really good at. Talk about your process, tee Chris up, and then we'll let Chris go off on his budgeting process.
Yeah, my personal process is the first thing I ask is, hey, do you all have a budget? That you look at least every other month to see what's coming in, what's going out, what your expenditures are. How much are you all dedicating to savings in order to help you afford to purchase the home that you want to? What things are you willing to give up and or sacrifice or even cut down some in order to get into the real estate game? And then I'll always say, hey, the sooner you buy your first house, the better the second house is going to be every single time.
I totally agree with that.
Yeah. The majority of them, they don't have a budget. It's intimidating. It's uncomfortable. And they just kind of, and I make sure, I obviously talk a lot, but I make sure that when I ask the question, I have to just shut up, and actually make them feel uncomfortable, where they realize like how important that question is. And of the 8% of people that you'd said that actually get to closing without problems, I bet the ones that have budgets and that are prepared in the front end and that aren't jumping into it emotionally, they are probably the ones that are best suited because they probably have a team surrounding them. They probably know where their money is going. They probably know like how their credit kind of works instead of, from what I understand, if I make payments, I have good credit then. So
you mentioned the budget and then you mentioned the credit, which are the two ways I think that we've got to help these people along. So let's get into the budget side and I'll come back to you about some of the credit stuff, Brian, that we can help the clients do. All right, Chris, get into, now you're sitting there and you want to buy a house. What's the budgeting process I need to start looking at to see if I can do this or not?
Yeah. Great question, Mike. So I think, the big thing is, somebody who doesn't have a budget, the biggest thing that we can first do is let's see where we have been spending money, right? So your bank statements, your credit card statements, whatever statements you have, whatever accounts you have, whatever allows your money to flow. Even if you're spending cash, then you have receipts, right? We're kind of away from the cash world, for the most part, but there's a transaction history. The first thing people want to do is really pull up that transaction history. Where have I been spending my money? You can look at that. You can look at 3 to 6 months worth of transactions and get a really good idea of where your money is going. Am I seeing Starbucks on that list every day? How much am I spending in gas, right? If I'm commuting,
Amazon.
Yeah. Amazon, right?
Getting food delivered.
Yeah. Amazon,
DoorDash.
Uber Eats, right? They're all pulling our funds, right? Maybe you do eat out, right? And maybe you see that. And so let's say, hey, rather than getting this delivered for $10, I'm going to go get in my car and they'll go pick it up from the restaurant. You're still getting the same product that you want, but now you're saving the $10 of somebody else delivering it to you, right? The Amazon thing, you joke about that, right? I think there's a lot of for married couples, for couples, there's this whole there's another 5 Amazon boxes on the front doorstep, right? And here's the thing, budgeting is big, but tracking against your budget is better, because now I can go and say, hey, those 5 Amazon packages, they're actually, it's groceries, it's this, it's that, right? And now I know what they're actually for. And hey, do I really need those things? You can buy everything and anything on Amazon, right? And so you're not going to be able to set up your budget and say, oh, this was an Amazon purchase. You need to identify and categorize what that purchase was. And then, is this a need or is it a want, right? To be able to track your budget. So one, I think the big thing is look at the transaction history, right? Where have you been spending your money? Where is the low hanging fruit that you can say, hey, you know what? I'm going to go drive and pick up the pizza rather than have it delivered. Or hey, instead of eating out 3 nights a week, I'm only going to eat out, 1 night a week, right? It doesn't have to be drastic changes, but little lifestyle changes will allow you to fill up that bucket faster for the savings of the 5% down or the 10% down. And then be able to see that, hey, I can afford this. I think, Brian, you would agree when people come to you that, we're going out and saying, okay, well, what can they afford, right? And that affordability really just looks at, their debt to income ratio. It's not looking at the PMI. It's not looking at all of those other things within the bucket of what a mortgage will include, right?
Oh, right. Yeah, I mean, it's so only items that were reported to the credit bureaus are the things that we're required to look at, the things that are decision makers. I always do the opposite and say, hey, outside of what I see in the credit report, what other expenses do you all have?
Right.
And it's usually kind of that silent, like the commercials that we see, where there's a person, hey, I'll give you $50 if you know how many, like how many, what do they call those things?
To.
Yes.
Streaming services. Yeah.
Yeah, exactly. And every time I see that, I'm like, oh my God. I'm like, I couldn't do it either. And I do this every single day because it's just so easy.
And Brian and I are the ones with the Amazon problems, not our wives. So,
but we're always buying stuff for them. It's like our wife comes to mind, our heart is fulfilled, and then we order something just so they know that we're thinking about them.
That's exactly right. So, but the it's so interesting because this. I mean, I think people will start in that conversation. They'll start looking at their streaming services, and that's why the thing that this other mortgage company is doing is so scary, because I think that's the easy one for them to go at. It's like, okay, we'll do, and I'm doing it right now. Like, we just got rid of Netflix. It's like I had to make. I'm like, I'm already paying for Amazon Prime, so I'm not getting rid of that.
I think it's cool, but here's the thing, Mike. Right? Like, okay, so you're going to target that, and that's $16.99 a month, right? If you have the basic Netflix plan, but I think it's the easy one, and I'm not sure why they keep going after subscriptions. I think people can get lost in subscriptions. I've even had our 3-year-old, we didn't put the parental controls on, and he's added subscriptions, right? So it can be an easy one in that aspect, but I think some of the bigger ones are our daily life habits, right? Like, sure, Netflix and chill, but what am I chilling with? Do I have
the pizza,
a 6-pack of beer and a pizza, and did I order all this food and all of this stuff, which are probably the bigger concerns, because those are going to add up significantly faster than your subscriptions, to Netflix, right?
But even like where you're, like, to your point, like even like where you're shopping from, like, am I going? Like, I've started shopping at Aldi a little bit, that kind of stuff. Just
enjoy it. I bring my own bag. I feel like I'm doing something good for the environment. I'm saving 12 cents by not paying for a bag. I love it.
Love it. Yeah, there you go. So
actually, I got one for Chris. So when you're recommending that they go back 3 to 6 months, how do you want them to track that? Do you send them a spreadsheet? Because let's face it, the majority of individuals that are probably 30 and under, they may just do screenshots and put little marks or something, or just look at an app. Like, so how can it be most impactful for them to do the work?
Yeah. So that's where I the service and process that I really am passionate about of helping people provide and understand. So The budget blueprint, our goal is, but making the budget's easy, right? For me in that perspective. But I think every budget is personal. So what Mike and his wife spend their money on is going to be completely different than Brian, what you spend your money on, right? It's going to be completely different from what I spend mine on. There you go. And so you're going to have, you need to have a category that says bourbon allocation, right? How much are you
not
spending
allocated
on bourbon? Yeah. Not to be confused with allocated bourbon. But how much are you spending on bourbon, right? Or guns or Amazon shopping or whatever that might be? It's identifying your categories, right? So what's special to you? What's unique about you? Because I think the world of budgeting, and when we talk about those other guys that are the click for you budgeting and things, it's very much you have housing, you have groceries, you have these generalized categories, and that's fine. And there's nothing wrong with that, but it's very surface level. It's not going to help you identify the areas where you say, oh, maybe I could get better at this, or maybe I'm spending too much in that. To really get into it. So to get to your point, what I offer is download your 3 to 6 months transactions, send them to me. We'll work out a process. I'll create a budget for you that's personalized for you, that's tailored directly to your situation. Talk about your goals. And then you'll get that budget whether you sign up with me or not. You'll see that 12-month budget. You'll have those categories and you'll be able to move on from there. The idea is not so much creating the budget. The idea is really tracking against your budget month over month over month to see how well you're doing compared to your budget, right? In the world that I live in, in corporate world, I've worked in finance and operations. We're putting together a lot of plans and forecasts. One thing that is for certain is that the second a plan is defined or a forecast is made, it's instantly wrong. The same as with your budget, right? Your budget, you're going to put together a budget, it's going to be wrong. You're going to underspend, you're going to overspend. But tracking it and seeing how well you're doing and being cognizant about those imbalances is how you're going to progress, forward into home affordability, right? It's how you're going to be able to see, hey, maybe I'm spending too much in this area, or I'm not spending enough in the savings area or in this area to get better. And by tracking that and having education and awareness of those spending is really what's going to put you forward in the race.
Yeah, you got to change the behavior at the end of the day, right? I mean, that's where it is.
Yeah.
All right, Brian, we only got a couple minutes left. I want to get into credit scores real quick too, just so you can kind of get some tips about. I think there's a lot of misnomers. There's probably a lot of people who think that, if I need to pay out this credit card, I got to do all this. I need to cancel this credit card. Which is, maybe not a good thing. So, talk people through credit scores and maybe some best practices around credit scores to help you look better on paper.
Yep. All right. 35%.
I'm going to start taking notes right now. So
yeah. Oh, perfect. I'll wait till you get that pen. Hey. All right, good. 35% of your credit score is your payment history. The most recent 12 to 24 months influences your credit score the most. 30% is basically your revolving credit. The amount of credit you have available, like as a limit, and what percentage that you spend, you ideally want to keep it under 30%. For those of you, and there's a lot of us adults that like to create a game where we earn points with credit cards by swiping it everywhere. If you're going to do that, log into the account before the cycle date ends. The cycle date is on the statement itself in the upper right-hand corner, and it's not the date the payment's due. It's the date, it's the to and from and to, whatever that is. Pay it 3-4 days before the cycle ends. This way, when it reports to the credit bureau, it's going to show a lower balance and then a lower minimum payment. That'll help you. Over the years, I've helped a bunch of people not spend more money, but make their payments more strategically to increase their credit scores. Mortgage interest rates and private mortgage insurance are both factored by your credit score. If you have a $699 versus a $700, there could be a $30, $40, $50 difference in your payment just for that little bit. 15% of your score is how long you've had credit. 10% is recent credit inquiries, which that's what people worry about the most. Oh, no. I heard my aunt Betty's sister's uncle's brother, his score went down 40 points because somebody looked at his credit score twice in a matter of a month. Total urban legend. People in sales are the ones that created that to keep people from shopping them. And then the last piece is the mix of credit that you have. Student loans, auto loans, mortgage, credit cards, that's fine. If you have 20 credit cards that's out there and nothing else, you're a high risk. Because in a matter of a couple of hours, you could stimulate the economy by maxing out your credit cards. So that's just bad for everybody. A suggestion that I have, if you're somebody that likes to click to buy, log into those accounts and remove every saved credit card that is in there. I probably have to do that once a year personally because it's just so easy to just log in, click, and then all of a sudden 2 days later it shows up and I'm happy. So, yeah.
There it is. All right. Chris, let's do a parting shot here. Most people don't budget, I think, because there's a lot of fear around budgeting. So
yeah,
it's not fun.
It's not fun, and there's some fear around, it's kind of like stepping on the scale, and really knowing the truth. So what's your biggest piece of advice to someone who's needs to budget? And then make sure you also kind of tell everybody where they can find you if they want to take advantage of your services.
Yeah. It's not taboo. It's life, right? Living inside or outside of your means is going to happen. We have to make progress. We have to see where we're at. We have to, I've been in a position, which is why I've created this, I got into a bad spot. I got into a bad position in my life. And I was like, hey, I'm never going to go back to that. And the way that I've done that is by budgeting and knowing where I'm spending. Are there months where I'm spending more than I'm bringing in? Absolutely. It happens. But if that is a continued trend, you'll get yourself in a bad position really quick, and you won't be setting yourself up for success. So it's important to budget, I think monthly at a minimum, to look at those transactions, to look at those. And if somebody is adverse to being able to do that or where to start, that's what I've created the budget blueprint for, is really to help people, gain the education and knowledge. I don't want to gain clients for life. I want to get a client. I want to, create a budget for them that works for them, that's personalized to them. I want to help them out over the next couple months. And then I want to give them all the tools that I use and teach them how to use those tools so that then they can take on the budgeting process themselves. I do my personal family budget. It takes me 15 minutes. It's a great conversation for me and my wife. I create like basically a monthly financial close process, right? Very businessy, but it's easy to read. It's easy to see. Did we spend more than we made? What were our high spending ticket items? What are some of our target areas that we want to focus on, as a family? And I have those, very clearly, very easily to see for our family to kind of discuss and look over. And I want to create that same ease, accessibility for clients and their ability to have those conversations. So budgetblueprintcoach.com. Check out the website, reach out. I'm on Instagram, Facebook, all those good things. And happy to help people in that process.
I know Brian will be someone who will be sending people your way more likely. So potentially.
Oh my gosh, yes.
Brian, parting shots for you from people who think they can't buy a house. And then how they find you too.
BrianTheMortgageGuy.us, BrianTheVAMortgageGuy.com. My number
loves helping his veterans, by the way.
I do because that's my special power. I didn't serve myself, but I'm a big fan of the red, white, and blue. And I noticed that I'm all decked out and stuff, and it wasn't intentional. It's just kind of how I roll every single day. Advice: believe in yourself, invest in yourself. There are so many naysayers out there that, oh, you can't do this, you can't do that. Or if your plan is to wait, I think you're kind of waiting to fail. That's not really a plan that you want to see through. So you make the hard decision.
Yeah, the pain of discipline is always going to be easier to swallow at the end of the day than the pain of regret. And I think that getting that appreciation cycle started as early as possible, even if it's not your dream home, right? Just understanding, maybe even doing that, you're actually put yourself in a situation where the first house you buy is your first piece of investment property that you're going to not sell and you're going to rent out. So there's so many just great things that you can do with real estate. The average homeowner net worth is 44 times greater than that of the average renter. And that's not a statement of how wealthy someone has to be to get into a home ownership. That's a statement of how wealthy home ownership makes people. And you need to have that appreciating asset to start working for you and really start to build that home equity. So, all right, guys, thank you guys very much. I hope this was informative. Again, if you want to get to the budgetblueprintcoach.com for Chris's work, if you want to find Brian, the mortgageguy.us, those are your best two ways to get those two guys. And we're here to help any way we can help your clients ease the path to home ownership. Talk to you soon.